Hi, my name is Z, the founder of Aion Finance. The summer is finally here, and today we're going to look at the best weekly option strategies for the summer trade. Let's begin. As an introduction, Aion Finance is all about looking at similar historical times in the past to find the best risk-reward option strategies to employ in the present. Now, as many of us know, the summer trade is very different than the rest of the year. Historically, the trading volume during July and August are a little bit lower than the rest of the year. Trade is slower, there's less news going on, and it's just a slightly different trading environment than what we typically experience during the rest of the year. There is an adage of sell in May, go away, which I never really understood because it has been proven that June, July, and August are some of the best months in terms of S&P gains over the last 100 years, and especially July being the best month. I think the 4th of July effect really has something to do with that. So we need to understand how to take advantage of these seasonal tendencies so that we can make money while relaxing on the beach or by the pool or wherever you want to relax. So the couple of questions that we're going to be talking through today are: 1, should we be net buyers or sellers of options? 2, what options are best to buy and sell? And 3, what option spreads have the best risk reward during this time? So we're going to use our bread and butter methodology where we identify a list of periods that we're interested in. So today we're going to be analyzing everything today and about approximately 2 weeks out in calendar days for every year. So it's about 2 weeks of time at the end of June and beginning of July that we're going to be looking at every single year for the last 10 years. We're going to be looking at SPY, options, calls, and puts. The reason why we are looking at SPY is because SPY has the most liquidity and it has the most expirations going back to the last 10 years. And what we're going to do is we're going to simulate buying the universe of SPY, calls, and puts, where the universe is 1, 4, 7, 14, 27, 42 days to expiration, and 10, 30, 50, 70 delta. So we're buying what is a good coverage of all the options that you can possibly buy on SPY, and the whole idea is to understand what are the best days to expiration and delta combinations to buy, which ones have the best P&L yield. And the way we do that is we settle all those options that we simulate to buy. We find their P&L by selling them to cash at expiration, and then we aggregate their performance by days to expiration and delta. Jumping into the platform. So here is the analysis where we are looking at all the data points with most similar fix. I mean, we're going to be looking at all the data points, so this particular piece doesn't matter. And we're going to be looking at all of these days in the past. You see that they're at the end of, June to the beginning of July. And here is the graphical representation of all those instances in the past. You'll see that most of them are, SPY being in a massive bull market for the last few years. And in particular, the summer months are usually just slow float up months. There is this one instance where we are actually in a bear market. But other than that, pretty much we're going to be going kind of sideways to up. So this grid shows you the results of the P&L for each type or each instance of an option that we sold. And the way we read this is for all 7 days to expiration 50 delta calls that we bought during those two-week spans for the last 10 years, there is about 1,000 instances of that occurring. And we made money at 65% of the time with an average P&L of 65.5, which means that for every $1,000 of options that we bought, we made $650 approximately. Now that is compared to the results of the last 10 years, every single day in the last 10 years. We only had a 43% win rate and an average P&L of 11% for every other day in the year. So the first thing that jumps off from this grid of results is that we are obviously really bullish during these couple times. Almost every single call option that you buy will likely have some positive. You are going to get positive P&L from buying call options, and basically every put that you're going to sell is going to yield a positive P&L during this time. Even some of the most unprofitable calls, such as these 1 to 4 days to expiration, 10 really far out of the money calls is likely to make you money. Although some of these, the performance of these are kind of driven by outliers because the win rate is so low. But the average loss is not that bad. And when you do hit on these kind of really out of the money lottos, they can pay off. So these things tend to underperform even in bull markets, but you see here during these 2 weeks, even these options are yielding positively. So going back to our first question number 1 is, should we be net buyers or sellers of options? And you can see that it's somewhat obvious that we should be net sellers of put options. Because some of these clearly show that it is significantly better to be selling puts during these times than it is during the average time in the last 10 years. However, I think in my opinion, it's actually still better to be a net buyer of calls than a seller of puts. And the reason is because of the return on capital. So for example, looking at this 7 days to expiration 50 delta call, if the question were to be, okay, should I be buying these calls or selling 50 delta 7 days to expiration puts, what should I be doing? I'm expressing the same directional bias. Should it be a seller options or should it be a buyer of calls? I would actually still be a buyer of calls, even if I'm expected to make slightly less money. If I were to buy $1,000 of calls, I would expect to make $650. Whereas if I were to sell $1,000 of premium, I would expect to make $800. But the problem with the $800 is that it has really poor return on capital. So looking at the options chain 7 days out, the 50 delta put is traded at around 475. So say you're getting 80% of that back, so you're making about $4. Rounding up, I think it's a little bit less than that, but whatever. It's $4 in return. Now, if you were to do this in a cash account using a cash secured put, you'd have to tie up $60,000 of capital for 7 days, which is less than a 1% yield on your. It's less than 1% yield on your buying power during that time for a week, whereas this is returning 65%, 65% return on your buying power during that week. And sure, you can sell it on margin. So instead of like 0.75 or 0.66% return, you can kind of jack that up to like 3 or 4%, but it's still kind of a paltry return. A very small return for the amount of capital you are holding up, whereas this is more risk defined, meaning that I only have $1,000 of risk on the outlay. You can easily lose more than $1,000 in this strategy selling puts, whereas I know if I'm wrong, I'm only going to lose $1,000, and I'm getting really good capital return for that $1,000. And if something were to happen against my position, I have the rest of my account in order to kind of repair that situation by selling close to dated calls or whatever. Whereas if you are kind of stuck in this put selling position, it's going to start eating up more and more your margin as the market moves against you, which gets you into a little bit of trouble. So in general, I am only a naked seller of options if there's nothing better to do. And if this entire graph were like mostly negative, then yes, I would start looking at put selling / call selling opportunities. But in this particular instance, there's just better things to do with your money than tying it up selling puts. The second question we have is, what options are best to buy or sell? And I would say probably some of these calls are probably the best to buy. So this one, the 30 delta 7 days to expiration, it's probably going to be my favorite, the one I'm going to be targeting when I'm trading to buy. And there are kind of call options that will give you better P&L. However, this 14 days to expiration one requires twice the amount of time it takes to recognize that P&L. So you're only making 50% per week, as opposed to 81% per week. And some of these closer ones, you'll see that the win rate will drop off because they're just more out of the money, so they have more volatility in their P&L. He says this goes down to 30%, whereas this is at around 50% win rate, which I think will work well for me. Historically, I have noticed that the 30 delta calls do perform better than the 50 delta calls if you were to be long calls. And the reason is because of the call skew. So as you get farther and farther out of the money, there is actually less volatility being priced in those options, and which makes them cheaper. And I think a lot of people actually, bread and butter is to sell these options right here. And I know that routinely these options are the ones that actually return better than selling even at the money. Like you're gonna collect more in premium than you are the realized move of the underlying. So it's just something to think about. The 30 delta calls I think are very, very nice. And lastly, let's talk about some options spreads with the best risk reward. So starting on the call side, we'll have calendars and butterflies. So calendars are basically selling one in the closer to expiration and then buying one in the longer in the farther out expiration. And that is usually good when you can sell something with a lower expected value and buying something with a higher expected value. So something I would be looking at is like maybe selling something in the short duration at 10 delta and buying something in the longer duration, not too long, 7, 14 maybe, in 30 delta. And and the reason why I'm going to pick these is because they have a higher expectation for their P&L than the things that you sell. You always want to be selling things that are not going to recognize as much money and buying things that are underpriced and have higher potential P&L. So I would be looking at that. I think that is a pretty good trade. The butterfly, like 30 delta to buying 130 delta, selling 210 delta, would also, I think, be something that is reasonable because the 10 deltas you can see are all yielding less P&L than the 30 deltas. So I think butterflies are probably a pretty good play. I would not do a butterfly that is like buy 150, sell 230, buy 110, because the 30s the things that you're selling are going to be yielding more value than the things that you're buying. So I would not buy a large kind of delta call, and I would not be doing poor man's cover calls where I'm buying a deep in the money or in the money call, because you see that the returns for these, even though they have very high win rate, they're just not yielding as much as a more out of the money call that is cheaper, that will get you more exposure to the upside for the amount of capital that you put out. So say if you're buying something that's 24 days out or 42 days out or even longer, those are going to have even more negative or lower expected P&L, and you're selling something that has potentially 80 like 65%. So you're going to say you sell $100 of credit, well, you're going to have to buy it back for $160. That doesn't seem like a very good deal. And sure, your underlying is going to appreciate a little bit, but it's as a percentage of what you paid for the underlying, it's not going to compensate. So you're better off doing a calendar that is like, somewhere out here in terms of P&L percentage than you are, say, putting out a huge capital outlay, doing a poor man's cover call, and only putting on one contract, whereas you can put on like 5 contracts of calendars or like 5 contracts of butterflies. So yeah, those are the kind of spreads that I would be looking for. if I were to do that. I'll probably not do anything on the put side. I might sell a couple puts, but I wouldn't do anything on the put side. And I probably wouldn't do anything on ratios because it's just, I mean, you're not going to get anything in the traps. So a ratio is when you buy one that is close to the money and you finance that buying one by selling more out of the money. And the likelihood of just that one put being in the money, the likelihood of the market going down during this time is just not very high. And you're just, once again, tying up a lot of capital, doing a 1x2. Maybe you don't do a naked, you do a butterfly, whatever. It'll be more expensive, but you're just not going to make money on the put side fast enough. So I hope you enjoyed this kind of analysis of what to do during a particular time frame. If you like this content, please like and subscribe, and comment what you want to see in the next analysis. And I hope you have the best of luck during this trading. Goodbye.